Coming up on Market to Market. Environmentalists blast the Obama administration's push for clean coal. And students gain hands-on farming experience at a leading land-grant university. Those stories and market analysis with Tomm Pfitzenmaier. Next.
This is the Friday, January 10 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. A key government report Friday revealed that 2013 culminated in the weakest month of hiring in 3 years. According to the Labor Department, U.S. employers added just 74,000 jobs in December after averaging 214,000 in the previous 4 months. Nevertheless, the U.S. unemployment rate fell 0.3 of a point to 6.7%. That's its lowest level since October of 2008, but the drop occurred primarily because many workers stopped looking for jobs. The labor report awakened hibernating bears on Wall Street, where the Dow declined on the news. Other developments, however, indicate a strengthening economy. The government reported earlier in the week that the U.S. trade deficit fell in November to its lowest level in 4 years, as strong demand for American-made goods and significant gains in domestic energy production lifted exports to an all-time high. But America's dependence on fossil fuels is not without its share of problems. This week, 300,000 people in West Virginia were ordered not to drink water from the tap after a chemical used in coal preparation spilled into a local river. The accident enraged environmentalists who were already sharply critical of the Obama administration's push for clean coal. The nation's newest coal-burning power plant, which is scheduled to go online in 2014, is being promoted as one of the cleanest on the planet.
In essence, this plant is part chemical plant, part power plant. What we do is bring the coal in, we gasify it, make some chemical products, and make electricity. In essence, it's a coal refinery with a power plant on the back end.
Located in Mississippi, the Kemper County Power Plant uses integrated gasification combined cycle technology to gasify the coal, remove the impurities, and capture carbon dioxide before it's released into the atmosphere. It is hoped that the nearly $5 billion plant will use carbon capture and sequestration, or CCS, to reduce its carbon dioxide emissions by 65%.
They've found CCS, I think, to be a very clever way of having their cake and eating it too. They can pander to the fossil fuel industry and the coal industry, and they can also promote what they say is a climate solution. But the problem is that it doesn't work.
The captured carbon dioxide at the power plant will be sold to oil companies, which will then pump it underground to force more crude to the surface. Some believe the practice of using captured CO2 to produce more oil is at odds with President Obama's stance on fossil fuels.
What is true is that we can't just drill our way out of the energy and climate challenge that we face. That's not possible.
So far, the administration has spent more than $1 billion on carbon capture projects tied to oil fields, and it's pledged billions more for clean coal. As a result, environmentalists feel the government is using green energy programs to subsidize fossil fuels.
The Obama administration stance seems to be that we can keep coal around forever. And the myth of carbon capture and storage technology is their illustration of how that's possible. They're not waging a war on coal. They're actually great PR for the coal industry.
America produced an average of 7.5 million barrels of crude a day in 2013. That was up nearly 14% from 2012 and the biggest single-year jump in U.S. history. Supporters of using captured carbon dioxide to produce more oil say that an increase in domestic oil production creates jobs and moves the nation another step closer to energy independence.
The key aspect of the technology is that it frees up, makes available for power generation a large share of the world's coal supply that was, as a practical matter, never going to be used otherwise.
In 1938, Dr. William Murray, An economics professor at Iowa State University developed an innovative curriculum. Murray was convinced that students needed the experience of managing a working farm to better prepare them for careers in agriculture and other related fields. A 187-acre farm was purchased for $150 an acre in 1942, and Murray's dream was realized when a herdsman was hired for $75 per month, and the first crop was planted in 1943. 70 years later, Iowa State's Ag 450 class continues to help students apply management and production skills learned in other courses, and the curriculum emphasizes real-world decision-making and problem-solving. Market to Market followed the class through the fall semester and discovered that the students, like many other farmers and ranchers, experienced mixed results in 2013. David Miller explains.
It's been a typical fall at the William Murray farm near Ames, Iowa. The harvest is bountiful. Grain is being hauled to the homestead for on-farm storage or delivery to nearby elevators. And hogs are being checked before they are sent to the local packing plant. On closer examination, however, you will discover this isn't the William Murray farm, but a working classroom, and the diversified grain and livestock operation is overseen by 54 Iowa State University students.
It's not just another class where, tell me what you want me to know, I'll regurgitate it back on a test, I'll get my A, B, or whatever it is, and we'll move on. They actually get excited about what they're learning, and I think that's really what it's all about. You're showing less nitrogen use on the home place, right?
Dr. Tomm Pfitzenmaier is part of a long line of professors who have acted as guides to the hands-on educational experience over the past 70 years. William Murray founded the class. It was his brainchild that came to fruition in the winter of 1943. Murray's idea was to give agriculture students experience in managing a working farm before they returned home to family operations or entered other agricultural professions.
We see this growth on a week-by-week basis. It goes from walking in starry-eyed saying this is going to be easy to saying, whoa, there's a whole lot more to this, and being frustrated with the amount of information and trying to discover what it is they really need to do, because we don't tell them everything they have to do. They have to decide.
To work on this farm, the only one of its kind at a land-grant university, you must take a course offered by the College of Agriculture and Life Sciences called Agricultural Education and Studies 450, more commonly known as Ag 450. A major portion of what happens here is determined by the students, and to get approval for any project, a student must convince a majority of the 53 other class members.
Contracted 10,000 bushels of corn.
Ag 450 provides an opportunity for students to explore ideas and concepts in a real-world environment. Many students operate complex farm machinery for the first time, while others gain practical experience with projects deemed too expensive to experiment with on their family's operations. Most of the students are enrolled in the College of Agriculture, but only 30 to 50% will return to family farms. Josh Favor will return to work on his parents' farm after graduation.
And I wanted to take it to try to learn new things, some technology, some new equipment that I might not otherwise have a chance to run, new ideas. And then that way when I go back to the farm, I can contribute some experiences and ideas. There are a lot of people who do stuff in life for the money. I'm going to farm just because I love it.
Class President Emily Reichert plans to have a career working on her family's farm.
Just the farm management part of this class really brings it all together, all those little aspects that we have to take courses on. It brings it all together to one course. I can relate it back to my home farm and also just really any job in the industry.
Students also receive guidance from Dustin Perry, a PhD student, and Greg Vogel, who helps implement the students' directives.
You have to be able in this job to allow the students to experience success and experience failure. And what I have found is they learn best from failure. I know I did.
Vogel, who spent 15 years in agricultural businesses after college, received his master's degree from Iowa State in the early 90s and has held the title of farm operator ever since.
Okay, we'll go ahead and call the meeting to order and have Sammy.
1 day per week is spent on campus discussing and voting on various farm project proposals. The class is split into 8 committees covering everything from crops to machinery to public relations. Each group is responsible for keeping the farm operating properly. The student farm managers also are required to spend 1 day per week at the Ag 450 farm located just south of campus. Because the on-farm classroom only holds 35 students, the class is split roughly in half. And students quickly discover one of the biggest hurdles to passing the course is finding ways to communicate effectively between the 2 sections. Everyone helps to keep projects on track by finding a delicate balance of personal meetings, email, phone calls, and handwritten notes. The ultimate goal of every Ag 450 class is to make the farm profitable 3 out of every 5 years. Utilizing a budget of nearly $750,000, this semester's class begins where last semester's finished. In the spring of 2013, 596 acres of corn and soybeans were planted on a combination of Ag 450 ground and other land owned by Iowa State University. An additional 800 acres were custom farmed for other university departments. And 3,500 head of hogs were finished on contract for a private Iowa company. As the semester drew to a close, 32,000 of the 45,000 bushels of corn harvested were sold to local elevators at an average price of $4.81 per bushel. And all of the 5,174 bushels of soybeans were sold at an average price of $12.60 per bushel. According to early projections, the 2013 corn crop was 30% smaller than expected, but the students making predictions in the fall of 2012 couldn't have predicted a second year of drought in Iowa and a decline of nearly $3 in price. But favorable oilseed production and prices may have cushioned the blow. The soybean crop was 8% larger than expected and sold for 60 cents higher per bushel than projected in October of 2012. The final accounting will be handled by those enrolled in the spring class of 2014. Spearheading the plan for 2014 planting intentions was Sammy Bissell of the Crops Committee. Her proposal for taking advantage of seed varieties with a higher yield potential was adopted by the 6 other members of the committee. Factored into their proposal were more expensive seed and the loss of 100 acres of rented land. Also on Bissell's mind was the thought of losing money. In 2010, the farm was a few bushels of corn short due to weather and yield estimates, and students from that class were forced to negotiate with the local grain elevator to satisfy the contract.
Most of the time, when you have 54 mines, they come to a pretty good decision because they self-check. But sometimes we have to step back and say, why do you want to do that? How come? How much?
So this is what asking for 56 tons of lime on 110 acres?
But if we give them a situation where they can come to that decision on their own, that's a lot better for them. And it's a little harder for us, but I think it's well worth it at the end of the day.
Okay, that one.
After satisfying Paulson's concerns, Bissell brought the proposal to the class for a vote.
Together, the whole crops committee put together our enterprise budgets. So with everything, all of our expenses, all of our inputs, we're going to make $78,828 for everything. Assuming we have everything paid for, and that has the drying cost of all corn included in there and stored. That has no discounts on our seed that we're potentially purchasing.
Your returns are projected off of bushels times the price, right?
Yes.
What do you use for pricing?
The corn was like $4.20, and our beans were straight $11.
The motion restated was that we would move forward with the proposed, and could I get a show of hands, those in favor? Okay, that's majority. Thank you. Motion passes.
Thank you, guys.
The entire presentation and vote took less than 5 minutes to complete. For Paulson, those are the moments he lives for.
In this course, there's a certain time where they start to get it, but they don't necessarily get all of it right away. But they realize real quickly that this is not their home farming operation. This is not another Iowa State University research farm. It's not another farm that maybe they worked at when they were growing up. And once they get that, they see that, and the aha moment happens, they start to make decisions that are based upon what's really here and not what somebody else wants them to make decisions about.
Next semester, another class will take over the operation with hopes of making it profitable and keep William Murray's dream alive. For Market to Market, I'm David Miller.
Next, the Market to Market report.
Grain prices were mixed this week as the trade prepared for a slew of government reports. And when the dust settled Friday, the downward trend in wheat continued, while corn staged an impressive rally. For the week, March wheat lost nearly 40 cents, while the nearby corn contract fell almost a dime. Soybeans bucked the bearish trend as the March contract settled with a weekly gain of 7 cents. Nearby meal followed suit, advancing by $6.50 per ton. In the softs, cotton continued its downward trend as the March contract declined by 35 cents per hundredweight. In the dairy market, January Class 3 milk settled above $20 again this week with a gain of nearly 50 cents, while the deferred contract moved 56 cents higher. Over in livestock, fat cattle traded in record territory again this week as the February contract settled with a gain of 40 cents. March feeders were off 45 cents, and the December lean hog contract declined by 85 cents. In the financials, the euro gained 6 basis points against the dollar. Crude oil shed $1.24 per barrel. COMEX gold gained $8 per ounce, and the Goldman Sachs Commodity Index declined by nearly 5 points to settle at 610.35. Here now to lend us his insight on these and other trends is one of our regular market analysts, Tomm Pfitzenmaier. Tom, welcome back.
Thanks, Mike.
We did have the big three government reports out on Friday, annual summary WASDE and the crop production report. Walk us through what we saw in those three reports and how the trade's going to respond on Monday.
Well, I thought the corn number was probably the most significant in that, through the fall we'd had gradual increases in the estimate of the crop yield. And historically, when you have increases through the fall, that final number tends to be larger. That's what the trade had anticipated. Corn market had sold off in anticipation of that. So it was a bit of a surprise when the USDA lowered their yield estimate, came in with a carryout or a production number and also a carryout number lower than the trade is expecting. I think there was a bit of a surprise that a lot of people have been talking that USDA was probably overstating feed usage, and they bumped that up another 100 million bushel, which was kind of caught some people off guard too. They did bump ethanol usage up 50, which is probably appropriate because we've been producing a lot of ethanol the last few months. So overall, I think the trade was caught leaning a little too much to the short side. We'd sold off hard, like I said. We recovered 20 cents of that sell-off on Friday. I guess I wouldn't be surprised to see a little bit of a carry through on that, maybe Monday into Tuesday, although I think the upside potential from here is probably somewhat limited. Carry out of 1.6 plus billion bushel is still ample quantities of corn. We still have the prospects. We have a lot of wheat around, which was also a negative report today, which was a negative report, I should say. And so maybe we can get another dime, maybe 15 cents. I guess I'd be surprised if there's much more than that in the corn market.
Watching this little pop we had on the corn market on Friday as we head into Monday, would this be a time for folks to start looking at making some new crop sales?
Absolutely. I think old crop, new crop, whatever. They're still offering some pretty good basis levels in a lot of areas for old crop corn. So I think you need to, there's two reasons there to look at making sales. Again, new crop was pulled higher. We got almost up to 460 on Friday. Certainly, if you get above 460 to 470, I'd be a seller of new crop corn, definitely, because acreage is probably going to be maybe not up, but certainly adequate. And and I just think we're probably going to build carry out again next year.
All right. Now you mentioned this report was bearish for wheat. We're just continuing that downward trend in the wheat market. Where do you think this could go as we're looking?
I think you're going to continue to see pressure on both corn and wheat in longer term. There's a lot of wheat in the world. The demand for U.S. wheat has been diminished. The crop is a little bit better than the trade was expecting. So I think you're going to eventually see wheat pull back and work its way down toward $5. I guess if you catch a little pop, or corn should happen to pull wheat up next week, that may be a good selling opportunity there too.
Time to jump in there and take a little bit of risk off the table.
Right, absolutely.
Now, how was the report in relation to soybeans? Relatively neutral, kind of right near traders' expectations?
Yeah, they did increase the bean yield 0.3 of a bushel per acre. That's exactly what the trade was expecting. They made an upward adjustment in demand on crush of 10 million and exports of 20 million, also fairly well anticipated. Completely left the carry out unchanged at 150 million bushel. So I think that the trade behind us, now we're going to look ahead at, okay, are we going to have Chinese cancellations? How's the South American crop going to develop? Are farmers going to plant more beans than corn next year? I think we're going to pretty quickly start focusing on those sorts of issues.
Now, as we start to focus on that, you raised the issue of Chinese cancellations and, again, that large South American crop. Should farmers be looking to make some 14 sales?
Definitely. I mean, that November of 14 contract has dropped quite a bit. It wasn't that long ago we were trading 11.50, 11.60, and we dipped up under 11 on Friday. So it's already taken a pretty good shot down. Certainly, if you should have some little hiccup in South America or anything that can bounce that up in that 11.30 to 11.50 area, we'd be sellers again.
Might be worth jumping in there and making a little bit of sales.
Yeah, because I think there's a lot of downside. If we have the acreage increase that everybody is anticipating, we have this big South American crop. You know, they're estimating the Brazilian crop at 90, and some even think it could be 95 million metric ton. That's a lot of competition, and eventually that's going to weigh on, especially on that new crop month. You could see that trade as low as 950 by the time the fall rolls around. So for those that want to make that switch from corn to beans, there's some downside price risks that you better take into consideration.
Some risk is on the table.
Yep.
Well, now let's look at the opposite side. So we take a look over at the cattle market. We've been setting all sorts of records in the fat cattle market, both on the board and in cash. Reports of $140 cash trade at $141. Cash trade, where is this headed?
Well, to me, it's starting to act a little toppy. That 141, 142 range, I think is going to be tough, because we're also, not only are we seeing the cash bids for cattle up, we're also seeing all the products go up. So, we've been talking really for a year about when this is going to start to hit a little bit, and we are seeing weights actually are fairly well under control. And why the heck wouldn't they be? If you got those kind of bids for cattle, you better keep moving them right along. But the product being that high, I guess I'm wondering whether we're going to be able to sell the beef. And I understand that beef is a quality product. It's perceived that way. When people go out to celebrate, they want a steak, and most of the time don't care what they pay for it. So there's that component of the beef market that's going to be supportive. But for anybody who's struggling financially, poultry and pork offer a pretty good value, and that's going to be a problem for the beef industry, I believe.
And now, is that going to be a problem we're going to see overseas? We know exports have been picking up. Where are we at priced internationally?
Exports have picked up in beef. They've really picked up in pork. I wonder about that. I happen to be in the camp that thinks the dollar, if we have Fed tapering through the year, which looks like probably a good possibility, that's going to tend to be dollar supportive. We've had the pretty well stated by the people in charge in Europe that they're going to stay accommodative to their stimulus. So I would expect to see the dollar gain relative to the euro and the yen. And so that's going to be kind of a headwind for these meat prices, both pork and beef.
Right.
But maybe it doesn't matter. Maybe we're going to keep. They want to buy the stuff bad enough that they're going to pay up for it. Right?
It's uncharted territory.
Yeah, it is. You're right.
Now, is this support going to carry over into the feeder market here? Do you think we'll see additional gains here in the next week or so as these cash bids make an impact?
I told somebody the other day with these high beef prices, for what they're paying for feeders, those guys must be assuming $1.25 corn, because they've really got them bid up, and it looks like they have no intention of stopping. So I would expect that to continue to be, as long as you got cash up and a downward trend in corn. I think that feeder market's going to stay, because the supply of them is pretty limited.
Mm-hmm. And you, we were talking earlier, you'd mentioned we had heard about herd retention or calf retention beginning.
That is not a big deal, but 2-3%, which is coming right out of that beef supply. So there's another supportive factor that certainly should keep that feeder market well supported.
You bet. Now, you mentioned the export market in hogs has been hot, and has been hot now for a couple of months.
Yeah.
As we take a look, we're continuing to see hogs slide. We dropped another 85 cents this month. Where do you see us going next week?
I think that there was a perception that PEDV virus was going to be supportive on the pork side, and that's turned out to not be as big a deal, partially because we've got heavier hogs, and that has created an increase in tonnage. If they start to get that under control a little bit, and we continue with these weights, then I think we're going to have plenty of hogs around. I think those June hogs up in that 101 to maybe up to 102 create a pretty good hedging opportunity for pork producers.
All right. Now, as we're looking in the short term, you mentioned, is the export demand predicted to continue in the hog market?
Yeah, I see no. Like I said, I think the dollar's going up, but probably not shooting up, just kind of gradually working up. And in that case, I don't see that having a big effect in the short run on pork demand.
Okay, probably going to continue as it has been?
Yeah, I think so.
Now, before we let you go, we have seen crude oil dropping pretty substantially. Do you expect that to continue?
Well, like your earlier report said, we're producing the daylights out of crude oil in the United States. I understand that if the economy improves, that's probably going to tend to help create demand for crude oil. But I also expect stocks to be relatively high. Stocks in the distillates, both gasoline and the other distillates, has been increasing. So is the demand for crude oil going to hold up in that situation?
We'll have to see.
Yeah.
Thank you for being with us tonight, Tom.
Thanks, Mike.
That wraps up this edition of Market to Market. But Tom and I will continue our discussion and answer some of your questions in our Market Plus segment online. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. And be sure to join us next week when we'll learn why hopes are high for one controlled substance to become a lucrative cash crop. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.